We're going to concentrate today on how to get yourself physically in shape and your finances tip-top as well. And that's where we begin this morning, with your finances. And to help us help you, we have with us today Ken Mahoney. He's an author on this subject, a personal finance expert. And welcome to the show, Mr. Mahoney.
Great to be here. Thanks.
Well, a few days to go. First off, what is typically someone's biggest financial regret as they come down to the end of the year and sum up how they did financially? I would imagine savings has to be on that list.
Yeah, not putting enough away, not kind of looking at it, because some great advantages to put money away to retirement accounts, reduces your tax liability, and, you know, yeah, we all could do a little bit better, right? No matter any facet of life, but particularly with savings, we all could probably do a little bit better.
Yeah, so that's number one, try to save a little bit more.
Right.
But we have several major categories we want to go through. Folks can look at these things as we prepare to turn the page on 2015.
Yeah.
First off, we hear maximize your 401k contributions. Explain why that's important. And is it too late to do it for 2015?
No, it's not too late. You can call your HR office. Maybe you have online access. But, you know, you can put up to the maximum. And what's important about that, any dollar you put away to your 401k plan saves money on taxes. So let's say you made $80,000 this year. You put away $10,000. It's going to show as if you made $70,000 for the year. So
you'll only be taxed on 70.
Yeah, right off the bat, you're actually making it 33% if you're in a 20% federal bracket, 7% state.
And it's tax deferred. Eventually, you will have to pay the tax.
Eventually you will. Eventually
but not now.
Yeah, right now. Yeah.
And then there's a maximum you can put in. I believe I heard you say it was 15 grand?
15,000. If you're over 50, you could add another 5,000. So there's a lot of flexibility. And look, this is the end of the year, and we're asked to do a whole bunch of things, but it's something to take a look at because it could really help out your taxes.
So you could actually call up your employer and say, I want to put another 10 grand in there. If you only had put, say, 10 and you could get to that 20, you could do that now.
Right, or offer earnings and so forth. I mean, look, the worst thing you want to do is go to your accountant in February, March, and he or she says, hey, you could have, would have, should have, put some more money in to save money in taxes. And you don't want to be there. You want to deal with that right now before December 31st closes.
And that is now the #1 way that people are counting on their retirement is what they have in their 401k. So thank goodness people have those at least. Number 2, we're told, squeeze in medical appointments and health insurance requirements before December 31st. Why does that one matter? It seems kind of obvious.
Yeah,
right?
yeah, definitely. Let's say, but a lot of plans have vision or dental, and you have to use in that year. Use it or lose it. And my friend who's a dentist, by the way, said he's so busy this time of the year. He wants to enjoy the holidays.
So we still can make an appointment with him.
But still make an appointment and try to get in because you have a certain lot of money that's dedicated for vision, dental, those type of things. Or if you have a health savings plan, to use that. But again, you have a few more days to get in there and get your teeth cleaned.
Or if you have some big procedure, try to get it scheduled. It may be too late to try to schedule it, but hopefully do it before the end of the year if you've met your deductible, because then your insurer will pick up a big chunk of whatever that procedure is.
It's all about planning. I mean, I think anything you think about finances, taxes, healthcare, all comes to spending some time thinking about it, planning ahead of time.
You can just go on the internet now too on any of these questions and get answers. I mean, you got to be careful that it's correct, but you can get a consensus. You know that I've heard about is an IRA conversion. What is that, and why would that be good for some people, and who would that be good for?
Right. So an IRA Roth conversion is kind of what they're talking about. You can convert it to a Roth because money comes out of Roth tax-free, different from an IRA. However, you really got to check with your accountant because you have to pay taxes on the conversion. But there's some years if your income is lower, you're a business owner, didn't have a good year, maybe that's the year to convert. But check with your accountant because you may have the opportunity to convert from an IRA to a Roth IRA.
Does that work best for small business people?
It can. I mean, it really depends because if you have losses for that particular year and have a zero tax bracket, that may be the year that you want to convert to a Roth IRA.
Okay, and then when we get our 401k statements, they're always telling us rebalance your investments, your stock, your bond investments. Talk about that. And, you know, and you got to get tips? No, probably can.
Well, no, think about it. 2015, the market's kind of flattish. But yet, if you actually rebalance the volatility, you made some money. At the end of the third quarter, September, market was way, way down. If you rebalanced and added more towards stocks because of what happened, October was the biggest month in 4 years. So the rebalancing from stocks to bonds on a quarterly basis, and most plans have that feature, you check off rebalancing, can really help the volatility.
What about someone nearing retirement? Do they have to use a different strategy when they rebalance?
I think so. I think you know, someone who's younger could be 70% in stocks, 30% in bonds. But someone gets close to retirement, they probably want to be almost the opposite, maybe 30% in stocks and 70% in bonds, because as they near retirement, that lump sum they have, they want to protect it also.
Well, I just read that the majority of people say that almost the majority of people saying they expect to die owing debt. That they thought that they will work beyond their retirement, and some people saying they'll retire until the grave. Do you find that you're finding people working longer and dealing with not having enough money for retirement?
I think so. I think that's happened. I mean, it's not your father's retirement, so to speak, where fathers and grandfathers and grandmothers had pensions. Now we don't have pensions. So without a pension for most people. But again, if they find purpose in what they do, it doesn't have to be so miserable, so to speak. It's something you enjoy doing it, you can do it too. I have a client who's 89 years old who's an attorney. Now, again, he doesn't grind it out 5 days a week, but twice a week or so he comes in, takes on a couple of clients, and it's something you're passionate about. It's pretty cool to actually not have to retire because you choose not to.
Well, and you can retire too as early as 62. Just know that if you continue to work part-time, there's some...
Yeah, the window from 62 to 66, you hit it right on the head. If you have earnings, it's advisable to take money out of Social Security at 66 because you give them back a lot in taxes. But that's the window. 66 is your full Social Security payment. 62, however, you can start taking out. But if you're working, we advise to wait to 66 to start taking out income.
Right. And now for somebody who wants to take their Social Security and then just work part-time, what part of that are they going to get taxed on?
Well, yeah, you have to stay under $15,000. So probably a part-time job would suffice there. So 62 to 66. Look, at 66, you can make millions of dollars. It doesn't matter. But in that window from 62 to 66, anything that's over $15,000 is fully taxable, and why we advise them to defer to 66 at that point.
Well, I like the part where you say you can make millions. So
sure, why not?
Maybe that'll happen yet.
Hit the lottery at 66 and older.
That's funny, right? That after you're all done, then you finally hit the lottery. Now, it's too late to make a difference this year, but a lot of people have found that when they have uneven income levels, maybe one person makes a lot and the other one person makes less, that at the end of the year they wind up with a big tax liability. Why does that happen, and what do you do about that?
Yeah, you know, most people go to their accountants February and March because they have an April 15th deadline. As Americans, we try to wait till the last minute for everything. But you know what? I always want to visit your accountant in November, December. Take a look at your year and see if you can make any changes, adjustments, withholding, taxes, and so forth that you stated. So it's not showing up February, March, and then seeing what your tax bill is. It's a kind of a quarterly basis. You're looking at where you are and staying on top of those things.
Why do you think people struggle to keep their resolutions financially?
I think it's with everything, whether it's health, whether it's fitness, whether things you're covering here on this show. I just think, you know, look, there's a law that says if you follow something 21 days in a row, you kind of created a habit. Most people don't get to that 21 days. So I think it's human nature. It's something we have to be disciplined about. But I think if you look at all aspects of your life, health, wealth, fitness, all these type of things, it's all about creating some type of, you know, mantra, something that kind of keeps you on track, being consistent. And doing it more than 21 days then becomes a habit.
Well, you hit on our theme here today, Ken. We're going to get our minds, bodies, souls, and our pocketbooks
all balanced
in shape, or so we hope. Ken Mahoney, personal finance expert, with some great tips there on how you can get your finances in shape starting with the new year. Thank you so much for joining us.